Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to Gervais Williams of Premier Miton, one of the most accomplished fund managers in the UK. So welcome, Gervais.
Yeah, it's something to live up to there. I don't get everything right.
Well, when we last spoke, we had a quick sort of chat on the top level markets, and you're rightly cautious on equities in terms of the schools going back and universities going back. But now we've had sort of like a triple dose of good vaccine news on Mondays over the last 3 weeks. What are your views on equities going forward in, say, next year and beyond?
But I think I think the UK is well positioned. I think we've got some cheap stocks. I think things are coming right regarding the vaccine, but also hopefully we'll get some negotiations and the Brexit issue will fall away as a worry for investors. I think the bigger picture is actually that we're actually looking at a long period when equities have been very good. If you think that actually all asset prices have been sensational for the last 30 years, if you had bought a 60-year bond in the government 30 years ago, in the last 30 years, you've had all your return.
Right, yeah. And also, I guess a lot of it's inflation, isn't it? Going forward, when it comes to bonds, if you believe there's going to be a bit of an uptick in inflation, then that's not going to be great for fixed income.
Well, if you've got your 60-year bond and you've had all your return, all 60 years return in the first 30 years, the next 30 years you've got no return at all.
Yeah.
Now that's not true of all equities or property, but basically the weather will change and it'll get much harder to make money going forward. And we've got to find individual stocks which are going to buck the trend. I think the UK economy isn't up to much, to be honest. It's slightly better than some and slightly worse than others. But I think the UK stock market is sensational. We've got opportunities to invest in individual companies which can buck the economic trend. There's more quoted companies below 150 million market cap than there is above it. That is nearly unique in the market. And that's an area where alpha can live.
And do you think there's any real risk with regards to Brexit, by the way? Because, I mean, the way I view Brexit is such that because we're in lockdown or semi-lockdown, there aren't many tourists and there certainly aren't many travellers going through the ports. And therefore, you've got 75% capacity underutilised. So even if they do start backing up trucks on the M11 into Calais, it doesn't really matter because they've got so much time and capacity at the border control to get goods, commercial goods and cargo through. So I think it's a bit of a non-issue, isn't it?
Well, certainly a lot of companies are small quoted companies, but they are still major businesses. They've got international operations. They may be operating in services rather than goods in and out and such like. So there's lots of reasons why that doesn't always make a difference to them. On the other hand, things can get wrong. They do go wrong sometimes. We've had problems in the past with immigrants trying to get through, and that's led to big backups before. So we've been through it. It's not good news, but hopefully, as I say, we're getting beyond that, and the news will be in the past before very long.
Yeah, no, I mean, I'm very positive in terms of the vaccine news because I've now started asking companies how they're going to fare in the post COVID world rather than what they've been doing over the last 12 months, struggling in lockdowns. Anyway, just moving on to sort of stocks. One which has obviously done very well for Premier Miton this year has been a Vactor. It's come off a bit because of the very good vaccine news because it's one of the leaders in, I think it's PCR antigen test. What is your view on a Vactor going forward? Because it's got revolutionary technology, hasn't it, in sort of like immunotherapies?
That's absolutely right. And I think if we do get vaccines, we're still needing to be checked before we go into a nursing home, before you get onto a flight, before you go into a school, for example. So I think there'll be an awful lot of testing still going on. And the main thing is, how big is that testing and are they going to be a big part of it? I think the answer is probably yes, but we still haven't got absolute confirmation on that. There does seem to be a direction of travel in that direction. On the other hand, you've actually got the therapeutic benefits. And I think the therapeutics are probably worth as much as the whole market cap is at the moment, probably a bit more. So from that point of view, you've got a double opportunity to come right. So I'm still pretty keen. We have taken some profits along the way, but generally, the risk-reward ratio still looks pretty good going forward.
Yeah, I mean, FinCap have still got their target price of £3.10 versus a current share price of £1.10, so there's plenty of upside. And you'd certainly intuitively think that given we've had a lot of people who haven't been able to have elective surgeries, then there's a huge backlog of cancer screening and cancer treatment, and these guys should be their technology should play well into that. Just moving on then, one again which has came out with results today, Cerillion. which is, I think, is a software for telco companies, customer relationship management software and billing and stuff. It seems to be done absolutely brilliant. It's moved into your top 2, I think, as the largest positions. Another home run.
That's right. I mean, it's actually it's a business which actually particularly works on the mobile technologies, and I think with Huawei not being used so much, I think there's more opportunity for them to sell some of their 5G solutions as well as some of their other mobile solutions. And ultimately, it's been a fantastic investment. If anything, we have been scaling back quite a lot of our high sort of multiple investments. The high beta stocks like the NASDAQ lookalikes, we've been scaling back some of those and putting it into more recovery stocks going forward.
Oh, okay. I wish I had a few more of those NASDAQ stocks that I could do that with. So, well chosen. But by the way, what is the USP for Cerillion? I did notice they've just won a landmark £11 million contract, which is their largest ever. And they've got an enormous order book of 31 million compared to sales of about 20. So, I mean, what differentiates them? Because I've always thought telco software is a real sort of like tough area to operate, but they seem to be just knocking the ball out of the park.
Yeah, they're particularly good when you get a number of different services being offered by a mobile phone company, and they are actually helping the mobile company actually provide a range of services rather than a narrow range of services. So they've got a recent order from a Belgian company where they're taking market share. It's a low-cost operator, but they're offering the increased services, and it just shows the quality of their product. You're absolutely right. The quality of their product is outstanding. Their customers absolutely love it. And generally, the very fact that they've kept going right the way through COVID without missing a beat is actually very impressive.
Yeah, I mean, sales were up double digits, weren't they, this morning? Okay, so it's basically they're playing to quad play and triple and quad play sort of services for telcos. And I guess with 5G, that's going to only increase, isn't it? Because people are going to want mobile TV on their devices.
Yes, in the statement today, they were very upbeat, not just on the long term, but on the short and the long term basis. Yeah. Which is obviously a very confident statement when you get that written.
Yeah, and another one which is reporting tomorrow, which you alerted me to, which was about 3 months ago, was AL World. And hey, that's double over 3 months for a FTSE 250. That's not a bad return. And I think the CEO, John Roberts, when he gave an update a few weeks back, said the sales would increase like for like 57%. But they're basically online sort of white goods sort of distributor, so fridges, freezers, bread makers, and all that kind of stuff. How do you see that business going? I mean, is it still good value, having doubled? It does seem to be cheap compared to the rest of them still.
Yeah, the market cap's come up quite a long way now. We don't know what the sales going to be. We'll find out tomorrow in the forecast projections. Somewhere towards 1.5 billion a year. The German sales were up 83%, I think, on a year-to-date basis. Clearly, it's a slightly more immature market, but even so, very impressive stuff. The issue is not so much about their sales, but how much cost is going to the business. They're moving very fast in terms of putting all sorts of green, powered bands in the systems and such like. The cost of customer service is very, very high, and they need to put an awful lot of money into that. So maybe the margins don't rise as fast as the sales do, but overall, the business is in a superb position to take more market share. It's an absolute cornerstone, I think, as a retailer going forward. Unfortunately, John Lewis have really lost heavy market share over recent years. So from that point of view, I think the momentum is still very much there. If you look at, say, Amazon's on about 4.5 times sales. This might be coming up towards twice sales. So it's still not expensive compared to some of their peers.
Oh, yeah. Well, I mean, last time I looked at Amazon, I think it had a PE ratio of 100, and it probably still has. Whereas I think the PE ratio here is, crikey. I mean, it looks it's a lot less, put it that way. And it's got a lot of potential. It's half the valuation. So, and certainly, I think it's 1.3 times sales. So, yeah, you're right. Significantly cheaper. So a big thanks for that for investors. I think that anybody who bought on the back of that 3 months ago did very well. Another one which is sort of like, done well is Totally, which is, I think, run by a lady called Wendy Lawrence, CEO there. Yeah. And that's sort of like been in this. It serves the NHS, I believe, with sort of like emergency services and like the 111 service and GP out of hours. And it's had a sort of like a mixed bag in COVID, but the shares have increased, I think, on the back of good optimism and potential new business.
Yes, I mean, it's very good because the business itself is well capitalized. It has an awful lot of cash on the balance sheet. It's paying dividends, which is always really, really, really reassuring. If anything, they have been slightly held back because they often do overflow volumes of emergency operations, things like, well, not emergency, it's elective operations, things like hip replacements and all that kind of stuff. And if anything, with the hospitals being sort of dominated by COVID, they haven't had much of that business. Clearly, that's all to come. That's very much a big order book to be dealt with next year. So we do expect that to kick on again with volumes in the next 12 months. And she runs it very well. Again, service levels are outstanding. The CSC, the Care Service Commissioner, actually gives them high rates for most of their premises, which is important. So I'm pretty upbeat about the business going forward.
And what's about the opportunity to sort of like improve the unit economics? Because the gross margins are slowly increasing, but they're still below sort of 20%. Is there any opportunity to put in sort of like artificial intelligence to reduce the overhead cost base, and likewise with or even the growth, the cost of goods sold, etc. And likewise with telemedicine going forward? I mean, we've just proved that telemedicine is going to be a massive growth opportunity. Is that another potential sort of string to the bow?
Well, they certainly use mobiles to monitor. So if you're at home and you need to have, a physiotherapy, then you go in and they double check that you've had your physiotherapy and how you're feeling next day and all that kind of stuff. So there's good opportunities to monitor patients, particularly home-based patients. I think there's other opportunities in different areas. There's a company called Couth, which came to market this year recently, which is all about online children. How well do you feel? And are you being bullied and all that kind of stuff? And they're extending that to adults. And that's more into the AI type thing. It's very much to do with therapists online to give people support, particularly if they're mentally under pressure.
Yeah, you'd have thought that if they invest in that technology, it's going to be a home run for the NHS because it's going to reduce their cost base and the service levels are going to, increase, get even better. You're going to get more patients who are going to get treated and seen, and it's going to be delivered at a lower cost. So it's got to be a win-win, I guess.
Yeah, absolutely. I mean, technology is definitely offering winners. Clearly, you can't just rely on technology. You actually do need to speak to people eventually. That's always going to be a cornerstone of medicine, I think.
That's interesting to say because I think the NHS actually has done a self-diagnosis tool. So you start speaking to a bot about your cough and your cold, whether it's COVID or whether it's actually just flu. Anyway, moving on to another medical one which has done well, Orphan. And that's really, I mean, you spotted this one obviously some time ago, but it's got the only sort of like 24-bed quarantine clinic for challenge studies, trials for COVID and for any other infection. I mean, must have a huge runway ahead.
That's right. I mean, they've actually announced quite a few orders recently. And as you say, it's particularly on coronavirus. And coronavirus is the common cold, but it's also COVID and other illnesses. So they're challenge trials. They're very strict ethics about this, as you can imagine. If anything, they've increased their capacity because they're now working with the Royal Free, where they've got the 2 top floors, where they're increasingly putting COVID challenges through there as well. So from that point of view, it's definitely increased its capacity. It's announced a lot of extra customers. To be fair, along with a lot of high-value NASDAQ-type holdings, we've taken our profits, not all of them, we've taken some profits along the way, but I still think momentum is very strong into next year.
Yeah. One you've again done well in, which isn't in the medical side, is Jubilee Metals. I've never come across these guys before, but I understand they sort of like have a look at the sort of like, metals tailings. So this is the waste, or effectively the debris that comes off an actual mine once the main metal has been sort of like taken out of the ore. And it's based in, I think it's based in South Africa and Zambia, etc. And is this an industrial metals / precious metals play on a rebound in the global economy? Because a cheap way into it to give you exposure.
Absolutely. I mean, the main issue is that they take the tailings dams and they clean them up. So actually, it's got a certain, environmental and social and governance actually positives associated with this company. It's not really had a proper, reflection of its the cash it's generating until recently. Share price, as you know, it's moved up from 2p earlier this year to a bit over 8 now. But even after that movement, even with cash on the balance sheet and the ongoing trading, the recent broker's note came out and it suggested it was on a PE of less than 5. And that's extraordinary after having moved from 2p to 8p. It's now.
How?
Yeah, so it's generating an awful lot of cash. I think next year it'll generate even more. They're bringing some more copper on stream at the moment. So they're doing incredibly good things. Yes, there is some precious metal in there, but there's also more mundane stuff like chromium and copper as well. So I think it's very well positioned should we see commodity prices rally because China and the Asian markets recover quicker than the European markets.
Yeah, I mean, I would strongly recommend, I don't own shares in them myself, for investors to have a good look at Jubilee Metals. I mean, you're right. The one, just at 8.5p, I get a PE ratio of 4 and an EBITDA multiple of 2.5. I mean, that just looks crazy to me. I mean, they're making margins, EBITDA margins of 47%. So, it's one of those which is right in the sweet spot of environmental and financial benefits, I guess. Another one on the healthcare side is, well, it's sort of like it's oral healthcare, etc. Is Venture Life, which I think is quite a big stock that Simon Thompson at Investors Chronicle also likes, and that's done very well for you.
Yes, it's amazing actually, because if you remember earlier in the year, they were selling Dental, which is a mouthwash which we sell in Europe, to the Chinese, and the Chinese were using it because there was sort of people like cleaning their mouths because they thought it might make a difference to COVID. Actually, what's been interesting is over the last couple of months, as they've had a trial with the Cardiff hospitals, and they have shown that actually that it does actually kill COVID in your mouths. Now, whether it makes a difference to your long-term prognosis, I don't know. But the main thing is that actually it is quite useful if you want to keep things under control in your mouth. So again, volumes have been very strong. They've generated a lot of profit. Share price has actually risen very hard as well. We haven't taken any profits on that one, but it's still a very successful company. But it is standing on a more demanding valuation than it was.
Yeah, but I think it's still actually cheaper than the sector for sort of consumer brands, isn't it? If you look at sort of like personal products, the Unilevers and the P&Gs of this world, then owning sort of like, I think is it Dental, is it? Then it still is actually much cheaper than those guys. Now, another one which I saw about 3 years ago, but didn't have the actual sort of stomach to invest in it, and wrongly so, was Wey Education. And I mean, the share, I saw them at about sort of like 4 or 5p. I actually couldn't buy any because it was liquidity wasn't a great. But now they're 28p. So I made a bit of a mistake there. And they do online education, I understand.
Yeah, and what's wonderful about them is they've got a long heritage. The Interhigh brand, which they have, has actually been there for many years. Yeah, and they've gradually built it up, so it's actually getting a much sort of higher profile now. They're very good for dealing with children who are wanting to do homeschooling, and if you haven't got enough time as a parent, they're very good in that. They've actually moved into dealing actually with more troublesome children with some of the local authorities, not through the Interhigh brand, it's a separate brand, but most particularly that could grow very substantially. And they're beginning now to get inquiries from overseas because British education has quite a good standard. So from that point of view, I think they're really beginning to push it. They're putting more money into marketing. They're raising their profile. The standards and the quality of education appears to be very good. So from that point of view, I think it has got all the ingredients to keep going now for another 3 or 5 years. And it could be substantially greater in due course in terms of scale.
And is it a platform stock? Because they've got their own education, i.e. their own services and their teachers, etc. But because they've got the technology behind it, presumably they can either franchise that out or deliver those services to overseas without actually owning the assets, presumably, as long as the quality is right.
Yes, I think they actually keep control of the teaching themselves. Okay. They're not short of staff, but they really want to control the quality of the education. That's obviously overwhelmingly important, the outcome for kids. And so from that point of view, I think but it can be done from the UK. It doesn't have to be done in different places around the world. So from that point of view, they're well positioned. Clearly, they could move overseas if they wanted to have another centre. But at the moment, I think the operation is very well focused. I think the growth potential is there as they inject more marketing. So I think the opportunity now just to scale it up considerably and get the operational gearing is very much there in the short to medium term.
Yeah. And one which has just raised £12 million, I'm just moving on, one which will raise £12 million at just on Friday, is Trackwise Designs. I never even heard of this company before. What does it do and what's its sort of USPs?
So it came to market nearly 3 years ago now. The main thing about it is it does... we get circuit boards. You can get them now with flexible backing, so it can make these circuit boards in unlimited length.
Right.
And the reason why that's interesting is when if you're in a wing of an aircraft, you really want your circuit boards in there, but you don't really want a whole lot of wires and such like, because there's all sorts of connections and they might work loose and all the rest of it. Whereas these sort of printed flexible circuit boards, one, they're more reliable, they're lower weight. And so from that point of view, actually, they can do amazing things. But it's not just that. You can use them in all sorts of applications. More recently, they've announced a very big order, which has really driven the share price, for being used in electric vehicles. And they are linking up all the batteries on certain electric vehicles. And of course, that could really be a very big market in the next few years. So they've got a very big, substantial minimum order. I think it's tens of millions. But
yeah, 38 million, yeah.
But most particularly, that's the minimum orders, right?
Right.
So if this thing takes off, and they're talking, the company giving the orders talking of coming to the US market quite soon. So from that point of view, it could be a lot more than that. On top of that, they're talking to all sorts of new applicants. So again, as you say, it's raised capital because it just needs to put more capacity in to keep up with potential demand going forward. So very impressive. It's wonderful to see these kinds of businesses being invented in the UK and delivering for people around the world.
This is patented technology as well, I believe, isn't it? So, they're the only game in town for it. And I guess with a traditional wire, I mean, I was an electrical engineer, but if you just have one individual wire, then it obviously can break. Whereas if you have a sort of like a flexible lot of, proper, wires all together, then an electric vehicle's obviously going to need a lot of wiring. Then it's in the perfect place, isn't it? I guess.
No, they've done they've come an awfully long way, because when it came to market, it wasn't that obvious. I mean, obviously
I wouldn't.
Right for our clients, but there it is. It's done an incredible job.
Yeah, another miner that actually, when I spoke to Chris Mills last week, and he's just bought into, is Kenmare Resources, titanium dioxide miner in Mozambique. Is that a similar sort of play on industrial rebound, so redeploying some capital?
Well, what we particularly like is investing in companies which are generating cash payback. I mean, Brian Carville, who's been running that business for over 15 years now, has probably invested about $1.5 billion into this mine. Titanium dioxide is used in paint, as you know, plastics. It's a whitening agent, and it now produces about 7% of the world's supply of titanium dioxide. Now, it's got about more than 100 years of supply there. And it's just coming on stream. And yes, I do believe that actually, if we do see the Asian markets recovering rapidly, if we do get a big sort of post-COVID splurge of consumer spending, you could see obviously demand for these kind of things rising a lot faster. Yes, but it's just a cash payback. I mean, the market cap is nothing like $1.5 billion. It's about $400 or $500 million. So from that point of view, it's on a PE on next year's forecast. I mean, it may not achieve those, of course, but it's on a PE of something like 5 or 5.5. Now, it's on a 25% free cash flow yield. Like, the debt's been driven right down out of it. It'll generate an absurd amount of cash, all things being equal. So that's just, life doesn't have to get more complicated than that. It's a superb business.
And if you're investing, one thing which has always been I've been hesitant is investing in miners in Africa, and in terms of particularly political risk, whether it's the black empowerment movement in South Africa or elsewhere. How do you price that in? As you basically just put a discount on multiples you'd be willing to pay with an extra sort of safety margin inside?
Yeah, the main thing is about risk is we can't be sure. This is in Mozambique, and of course, it's one of the safer countries in Africa, but it may be less safe in the future, and we'll find out in due course. But from the point of view of portfolio management for our clients, if we make sure that we actually have risks which are less correlated. So how many other risks do we have in Mozambique? Well, zero is actually the answer. Right. Yeah. So if it all goes horribly wrong in Mozambique, and let's hope it doesn't, but say it does, clearly it'll be bad news for this company. But we've got lots of other companies where it doesn't go bad news. And so ultimately you can dilute risk by diversifying across a whole range of different holdings. That's how we deal with this risk. Yeah.
Okay, and then another one which is again in the sweet spot of sort of cyber security is Carrero. I think you've owned it for some time, and it went down to about 3 or 4p, and sort of like rebounded to 8 or 9 now, and it again had a record level of new orders in Q3. I think it was $6 million worth of new orders, 9 new customers, and it's got obviously a partner with Juniper. How do you see that playing out? I mean, it's one of those which hasn't done much over the years, but again, you'd have thought sort of like software that helps companies prevent distributed denial service attacks, we should do well.
That's absolutely right. I mean, obviously, the nature of risk is out there that, your website doesn't survive and you get knocked over and it gets attacked and people infiltrate. So from that point of view, it's a big issue. It's actually one of its customers. I mean, the quality of the Carrero product is so much that it responds very quickly, much quicker than competition. So from the point of view of people like the US Fed, if they put, the interest rate change on the website, they don't want it to be knocked over by some malicious force thereafter. So that they use, the quality to have Carrero, that kind of quality of product out there is great. But the key issue is getting it into the market. It's no use having the best product. It was, as we saw with Betamax, VHS won the battle in the end. So you need to get in the product into market. And I think the Juniper connection has been outstanding for them. It's taken a little while to get really full on, but now it's embedded in their product. When you get Juniper, you can just turn it on if that's what you want to do. So we're beginning to get real volumes coming through, and I think that's what's been really driving their share price again. Again, we have taken profits, not because there's anything wrong with the company, but as I say, we've taken some of these high beta stocks, we've been taking profits and recycling into some of the more recovery stocks.
Well, sort of top level logic would say that given we've moved into sort of like more online e-commerce, and you just got to look at sort of like, your Amazons and even your Tesco online, where they're doubling the sales over year on year, and AOL, AO World, etc. Then, given commerce is now more important to be done online, these types of services should just be in a perfect place at the right place at the right time, you'd have thought, logically.
Absolutely.
Yeah,
I wholly agree. I mean, if you've got access to market and a great product, one hopes, therefore, you get great sales in due course.
Yeah, and one on the insurance side that I think again Chris Mills likes is Randall and Quilter, which is I think it's a run-off insurance type business. Is that really again a sort of cheap insurer with a big sort of like cash payments?
Yes, it does do some reinsurance of sort of companies who come to an end and they take on the tail of their liabilities. And that's been good. It's generated some profits. But actually, the key driver of this is that they've got a distribution network for new insurers. New insurers are coming into the market now because although there's established insurers, you can begin to insure things on a use basis. So if you want to, if you're say, a delivery driver for pizzas, you might want to be insured when you're actually on the motorbike doing the pizza delivery. When you're not working, you're not in their insurance. So you have to log on and log off at different times. And this is allowing new entries into the market. So in the US, if you want to sell insurance in the US, you can only sell it on the individual state's approval. You have to go to each individual state. They all have their own approval process. It takes an awfully long time. And the great thing about Randall and Quilter is they've got that over the whole of the states. And so you can go to them, providing they're happy with your service, providing that you're giving an outstanding quality of service, then they will let you use their network. They charge you a small amount for it. And so they get fees for almost no risk. So that point of view, they could grow their fees. They've been announcing an awful lot of contracts recently. They got the same kind of thing in Europe, actually. So now after Brexit, if a Lloyd's business wants to insure into Europe, then effectively they can use the Randall network, Randall and Quilter network. So the underlying feature is that the momentum in the business is incredibly strong. And so from that point of view, if we can just see that cash payback coming in the next few years, we think it'll really drive the dividend. Dividend yield is around 4.25 moment, but we think that could be driven on quite considerably, assuming they get the cash payback on the new customers over the next 2 or 3 years. So very excited about the upside.
That was one of your recent purchases, isn't it? One of your new ideas. I mean, the PE ratio is still less than 9, so it's certainly not expensive. Yeah,
we've known it for many years. Actually, what we've done is we've built up a bigger holding. Given that they raised some new capital, we've actually been able to take a slightly bigger stake.
Yeah. Well, last time we spoke, actually, you were talking about gaming stocks, and you've sort of like found another nugget, which is Gaming Realms, which does mobile games with Slingo, I think it is, and just had a big deal with, I think it was Paddy Power I read about, I think some time ago. So
that's right. I mean, the Slingo thing is actually very good because, as you know, a lot of the US states themselves are opening up at the moment.
Yes.
And, clearly they need extra tax revenue, and this is a way of generating extra tax revenue. So we expect it to be quite a wide-ranging feature. And we think the Slingo will actually be adopted by quite a number of the operators over there. And they're getting all sorts of negotiations coming through. And if that does open up, then hopefully that would lead to volumes coming through quite strongly. So yes, Paddy Power is certainly one of the ones they've done it with. But they're doing. One hopes there are other opportunities for them to open up with other US players in due course as well.
And there's consolidation in this area, isn't it? I mean, you saw William Hill just being bought out by, I think, some big US casino, Caesars, I think it was. So that seems to be, I think that's going to be a feature M&A going forward in a lot of areas.
Yeah, the UK really excels in this area. So if you want to bring in a company with a lot of skills in this area, you're probably going to acquire a UK business. There are some Chinese and Hong Kong businesses in this area too, but particularly the UK, has seen quite a lot of takeovers over the years.
Yeah, well, I think RSA, the insurer, was just running back onto Randall and Quilter. RSA has got taken out at a 50% premium. So, the insurer Randall and Quilter is probably, if these sort of like choice assets stay cheap, they don't stay cheap for long. With sort of
I think takeovers have been quite strong this year, and certainly after Brexit, assuming it's not chaotic, I think you could see some more takeovers coming, and hopefully the share prices rise faster than the takeovers so that we don't get all of our businesses acquired. Because clearly we want our businesses not to just be taken over. I've had 20 takeovers probably in some of our funds in the last couple of years. And if anything, I'm quite disappointed. I'd rather they weren't taken over, and I'd rather they were still in the portfolio for our clients for future years, because I think they'll generate a lot of cash going forward.
Yeah, well, hey, at least it's not a bad plan B if somebody takes it over. Which is again probably sort of like in the takeover crosshairs, and I clearly don't know, but it's had a tough time, but it's got good sort of. It's Pennant International, which again is a new sort of like idea for you guys, and I think you've bought in at a very sort of like modest valuation level. How do you see that? It does basically, is it simulators and trainers in the defence sector? It's obviously been hit by COVID with the aviation side.
Yeah, it's had a difficult year or two, actually. It's, so actually, the profits have been quite disappointing over those last couple of years, and the profits are driven down the valuation. So you're getting again into a very strong business. It's very good, particularly in training. We think there'll be significant volumes to come in the next 12 months, the next 24 months. As we know, the government's actually stepping up government spend on MOD going forward. We think this business was particularly overlooked valuation we invested in, and we think it's a very small business, but we think it's a world leader in its industry. Yeah,
well, I mean, you thought with the rebound in sort of aviation, then it should do well with sort of simulation and all those kind of stuff.
Yeah, it's terrific business.
Yeah, just on something you've been trimming down. I mean, there was a couple of sort of like, again, almost battleground stocks that you and I think you and Simon Thompson, the Investors Chronicle, have been butting heads on. Is Cape Technologies and also Cromec, whereby he's been recommending to buy and you've been sort of trimming whilst he's been recommending.
Yes, I mean, Cape, again, has done incredibly well. They've raised about $100 million recently to adjust the deal which they did with Personal Internet. Yeah. That reduces their tax charge, it increases the earnings. But again, as I say, we've been trimming quite a lot of the high beta NASDAQ type stocks. Yeah. Cape is an excellent company, continuing to be, like-for-like sales in the US are excellent, but we have taken substantial profits. Cape, has done well. Cromec has done less well. To be fair, we've been waiting for orders. They haven't really arrived as quickly as we would have liked. And they probably will come, but we've actually redirected capital into some of the more recovery stocks. It's still a bit of a technology stock. And as I say, we've been bringing down the high beta stocks, albeit Cromec hasn't really succeeded as a high beta stock for our clients. But we're finding more recovery potential coming through in other companies.
Yeah, no, I mean, you have been an anchor investor in sort of Cromec for many years. So, I mean, when you've got opportunities to redeploy, then that makes sense. One which you've done well in recently is OnCimmune, which does immunodiagnostics sort of leading. And that is a really hot area for M&A because you've had sort of Exact Sciences just recently buying, I think it was Thrive for $2 billion, and you've had Illumina buying Grail, I think, for $8 billion. And if you run the same sort of multiples of R&D, you still get a huge runway, sort of 4 to 6 times sort of like, the spend they've done on their immunodiagnostics platform. And you get a sort of a share price of £4.30 compared to a current price of £1.70. So I was just wondering what the logic was of sort of trimming that. Again, is it high beta or...
That's right. Again, it's medicine, it's high beta, it's a liquid biopsy business, and as you say, it has some very strong data, incredibly strong data actually.
Yeah.
The share prices perform very strongly, and we are looking to redeploy into things which are more recovery, more cyclical. And so we have taken, in fact, we sold our entire holding in that for our clients. But generally, I mean, it's still a good business. Don't get me wrong. We're not selling it because it's bad business.
No, I know.
The valuation has moved up, and we've got other things where the valuation hasn't moved as much, like Pennant and stuff.
Yeah. No, I actually spoke to the guy who bought part of your shares. He was delighted that you sold down. He thought, thank you. He said, thank you very much.
I'm delighted for them because I want them to have supportive shareholders. So if they need to expand at a faster rate or they need to access the markets, I want them to have supportive shareholders.
Yeah, I mean, another one was is Inspiration Healthcare, which has actually done really well during the COVID because it's been it's had sort of like some benefits in terms of making, I think it was ventilators and that sort of stuff. And given everybody's been locked down in April and March, then you're probably going to get a boom in babies in about 9 months. And they do sort of neonatal care equipment for hospitals. So they do sort of distributors their own equipment and consumables. And I think it's still a very big holding, you've still got, but you just sort of just tick down the level, I guess, as the shares have moved up.
We have a little bit. I mean, the whole point about that company is it's absolutely doing wonderful work. It particularly deals with preterm babies. It's got a very strong market position with its recent acquisition now in the Asian markets as well as the US and UK. So all of that's very, very strong. The issue actually is that this business might have something really exciting as well going forward. A company called Wave, which is an acoustic device which helps babies sustain breathing. And that's one of the main problems actually with preterm babies is they don't breathe continuously. They stop and splutter. And that means their oxygen levels go down and they grow a little less quickly. So from that point of view, this product, we'll have to see, but they're upbeat about the prospect for this product to actually make a major difference to all preterm babies in terms of their breathing. Goodness gracious, wouldn't that be a wonderful thing if they were able to bring something like that to market? It's still going through the clinical processes, but again, from our point of view, that would be not just the success of the business, it'd be transformational potentially over the next 5 years if it was successful in its way product.
Yeah, no, I mean, I'm with you. I mean, I understand. I mean, it could be breakthrough science, and the standard of care at the moment is I think it's a caffeine injection, so it isn't exactly very sort of like a high bar to get over. And this could be a major leap in the right direction. One thing I've been sort of like, again, it's been almost like a perennial disappointer, which if you've trimmed down on is Begbie's Trainer. Now it does insolvencies, and after the sort of 2008, 2009 sort of banking crisis, we all thought, God, there's going to be a boom in insolvencies. But because interest rates went down so much, then it meant you've got these whole zombie companies, and you didn't get that sort of like enormous sort of like lift in the number of sort of bankruptcies. But I'm guessing you are seeing a few now in sort of retail and leisure and restaurants. I mean, you just got to look at it. Peacocks went the other day, and it was just sort of like quite an interesting one. Is this going to be the day that they actually do well, or is this going to be again a sort of like another disappointment?
Well, one of the features about bankruptcies is that obviously you have to go in and look after the creditors and sell the business if you can to another owner and deal with it. If you go into a business which has very, very little assets, then you can do all of your work and not get paid at the end of it because there's not enough assets to pay you, let alone the creditors. Yeah. So from that point of view, actually, it's quite if things get too tough. Yeah. It doesn't work out very well for the industry. It's a good company. It actually has some reasonable results. As you say, the sectors, there's more opportunity for them going forward. If anything, we've moved into a company called FRP, which came to the market earlier this year. They're more in administration. They're particularly rescheduling of debt. They've been taking some of the bigger orders, things like when Debenhams went down, Edinburgh Wooler Mills recently. And we think, in fact, that company probably is going to generate more cash than Begbie's going forward, albeit that the valuation's moved up since it came to market earlier this year.
Yeah, and the other thing I'm guessing with insolvency practitioners is that the working capital is quite heavy because you only get paid right at the end of it, don't you? Once you've actually completed it, it's closed down and everybody pays for the assets, which isn't coming 9 months, 12 months afterwards, or even, I remember, was it... who was it? It was basically after financial crisis when Lehman's went down. I think the only PwC, albeit I think they did get a big $400 million fee, was only paid like 5 years later. So
this can be years. You're absolutely right. I mean, working capital can be a real issue. Absolutely.
Yeah, and two which again were sort of like consistent with your themes of sort of like taking down high beta stocks. Loop Up and Jenny Drive. Loop Up obviously a beneficiary, a bit like Zoom, I guess. And Jenny Drive doing sort of like hepatitis virus testing and stuff.
Yeah, again, I mean, these are companies that we were invested in because they're good companies. Loop Up has done a further deal since we sold it. But again, in both cases, we've sold the holdings for our clients. As I say, these are excellent companies. We're very supportive in a way of what their management's doing, but the share prices are so much more. They've run ahead. compared with other things which are much more overlooked. There's real opportunity to get into other things where the upside may be more substantial in the short term.
Yeah, and just sort of going full circle to where we sort of started at, your funds have been doing great this year. I mean, my value orientated portfolio has actually recovered a bit because I think small caps have done quite well over the last 3 weeks with obviously the vaccines, but I'm still down year on year. And your sort of portfolio, I was looking at the micro cap, is up 25% or something this year, and likewise I think the other main fund has done very well. That sort of sets quite a high bar for next year, Gervais. Have you got sort of like any more sort of like other tips for people to sort of like to watch or run the slider all over?
I think the main thing is just look at the cash, right? Yeah. Cash in for cash out. And if you get cash out reasonably quickly, and if you're lucky enough to be invested in these companies, then that can drive share prices quite a long way. I think probably the most recent investment is a company called ACRL, and we've already had a shareholding. And recently, we supported the major deal. This had 8 major converters. This is for loo paper.
It's toilet paper, isn't it?
They've been taking market share from Andrex and others. They were capacity restrained, actually, with the quality of service and the quality of their product.
I'm not surprised in COVID.
But what's actually happened is they were going to have to put some new plant up. But they've just discovered a new plant, actually, which was underused in Leicester with 4 machines in. They've got 8. That was running at about 55% capacity. So they can use that now to put all the overflow volumes which they've got in the short term and get substantial cash payback. I think there's just a note out from Zeus this morning. But basically, the momentum for them to get a very substantial cash payback over the next 18 months as they move towards full volume through this new Leicester factory, and most particularly, hopefully, continue to expand even beyond that, is just perfect. And it's you might say it's a dull business, and in a way it is. But they run it so well. The staff engagement, the quality of service levels, all of those things are such good stuff that actually you can still actually make a very good return from shares in these kinds of companies. So that's the kind of thing we've been more involved in recently.
Yeah, I did actually speak to another investor who was talking very positively about ACRL. So I would agree. Investors, if you want a sort of like old economy stock that sells toilet paper as a DOB to some of the big, large grocers and multipliers, but it actually does really well on its margins. Have a look at ACRL. I mean, I don't own it. My father does. He's a long-term investor. It's been a sort of like one of those ups and downs investment. But I think as a recovery stock, it seems as though it's learned its lessons and it's got a good future. It should come through next year. All right. Well, thanks very much, Gervais. That's been absolutely fascinating. And thanks for taking us through what the portfolio has been doing over the last 3 months. As I say, I wish going forward I can deliver the same returns as you, but I've got no chance of sort of like 20-30% per annum. So,
well, it doesn't always come quite when you want it. Last year my funds were more difficult. So the main thing is that if you invest in companies with strong balance sheets, and if it doesn't come this year, hopefully they don't need to raise money and it'll maybe come next year. And that's the way so secure balance sheets with major cash payback, albeit that it sometimes comes a bit quicker, sometimes it comes a bit slower, is the key issue which drives our stock selection for our clients.
All right. Okay. Well, we'll speak to you in the new year. So thanks for your time there, Gervais.
Thanks very much, Paul.